The prospect of future industries revolving around the metaverse, virtual worlds, has received a lot of attention. After all, social media giant Facebook, ticker FB, changed its name to Meta last month to reflect its ambitions to build the metaverse, where augmented and virtual reality will allow users to interact in online worlds that include games and shopping. Nvidia, the computer chip powerhouse, unveiled new software and computing tools last week as it firmed up its own competitive push into virtual worlds, which it calls the Omniverse. Its innovations include a platform for generating artificially intelligent avatars, and a computer engine that will help train the deep neural networks that make up AI. Optimism over Nvidia and the metaverse has helped the stock surge in recent weeks, and that was set to continue Thursday after the company posted strong third-quarter earnings. CEO Jensen Huang didn't skip an opportunity to talk about the company's future in virtual worlds, outlining how Omniverse brings together Nvidia's expertise in AI, simulation, graphics and computing infrastructure. "This is the tip of the iceberg of what's to come," Huang said in a statement with the company's earnings Wednesday. "Virtual worlds have never been more real. And while investors inclined to get ahead of the trend may be looking immediately at the high-tech stocks powering the future of the metaverse, the opportunities are in fact far more diverse. The luxury sector is one of them. Digital assets could constitute 10% of the addressable market in luxury goods by 2030, representing a €50 billion, $57 billion, revenue opportunity and increasing industry earnings by up to 25%, according to new research from Morgan Stanley. Today, people spend more time interacting with their friends on social media and in gaming platforms than in real life in the developed world, said the team at the bank, led by Edward Stanley, Edouard Aubin, and Elena Mariani. As more aspects of people's lives move to the internet, demand for digital fashion and luxury goods is set to increase dramatically in the coming years, the team added. There are fundamentally two different branches of metaverse opportunities for luxury companies. The first is in gaming, particularly video games that are social and have a lot of emphasis on player image. Allowing users to pay to add luxury products to their online avatar, including through revenue-sharing agreements with developers, is on the rise, according to Morgan Stanley. Tangential to games are online events, such as music festivals, which have the potential to reach a massive audience of young consumers. Along with luxury brands, beneficiaries of the events trend include the likes of Universal Music Group, UMS. Netherlands. The second metaverse opportunity is in non-fungible tokens, NFTs, which are tokenized versions of digital media that are hosted and traded on the blockchain, the decentralized ledger technology underpinning cryptocurrencies such as Bitcoin and Ether. Luxury companies can sell exclusive versions of their digital products for a hefty price tag. Dolce & Gabbana sold 9 NFTs for $5.7 million, according to the bank's research. NFTs are only growing in popularity. Each addressable market should contribute a similar sales boost to the luxury sector in a bull case, according to Morgan Stanley, but NFTs are likely to be more profitable. While gaming collaborations are, we argue, more advanced in their ability to generate revenue and a wider halo effect for the industry, NFTs present a more material EBIT upside opportunity over the remainder of the decade, said the team at the bank. Gaming collaborations could constitute 40% of metaverse revenue by 2030, but only 20% of profits. While revenue from digital mediums remains negligible for luxury brands, the opportunities are only increasing, according to Morgan Stanley. While the metaverse will take years to develop, and there remain risks to its long-term future, social gaming and NFTs are near-term plays. The whole luxury sector is likely to benefit from these trends, but some companies are better positioned than others. Namely, soft luxury brands, which make ready-to-wear items such as leather goods and shoes, are in a better spot than hard luxury groups specializing in the likes of jewelry and watches. And if it's true that users will be more inclined to wear designer leather jackets than Rolexes in the metaverse, The Morgan Stanley team has a winning stock pick, Kering, France. The French luxury goods group owns brands including Gucci, Balenciaga, Yves Saint Laurent, Alexander McQueen, and others. It's the best placed given the brand's demographic, as well as the company's head start in innovative digital collaborations, according to the bank. Balenciaga, for instance, has a new partnership for in-game merchandise in the online game Fortnite. Users can buy real-world clothing lines and see an in-game billboard that has also appeared concurrently in New York, London, Tokyo, and Seoul. Gucci, on its part, has a collaboration with online gaming and game creation platform Roblox, RBLX, allowing players to purchase virtual products. There was so much hype to buy a virtual Gucci purse that it resold within the online marketplace for more money than its real-world counterpart, according to Morgan Stanley. Shares in Kering, which are also traded in U.S. over-the-counter markets, have climbed more than 25% this year. Metaverse is not just some futuristic idea, early versions already exist, the team at Morgan Stanley said. It offers a big opportunity for digital-only brands. But luxury brands, with their vast intellectual property built over decades, are set to be amongst the main beneficiaries, it added.